Hello, everyone, and welcome for being here. Thank you for being here. This is Mohammed Yaoud, Market Analysis Manager at PU Prime, and today is our third session in the campaign. Uh, you can be a trader too. This is basically targeting only our um, traders who have zero experience in the financial markets. This is the third session. Basically, we had conducted two previous sessions about how to kickstart your financial trading career in the markets. We had some details or some explanation and demonstration about some basics in the first two sessions, and today we're gonna continue a little bit about more details about technical analysis, Charles Dow, and a few topics that you will find interesting. If you have any questions, please leave it in the chat box, and we'll definitely conduct a question and answer session at the end of our webinar in order to get everything covered for you. So today is the third session that we will be having, and the title is How to Read Price Action Using the Dow Theory. Basically, if you're going to get into the technical analysis session or the technical analysis part into the financial trading career, you will definitely hear about the Dow Theory terminology a lot. So let's get this covered today real quick, and we will just get into this right now. This is Mohammed Yaoud, and I'm the Market Analysis Manager at BU Prime. I've been in the financial industry for quite 4 to 5 years now, and I am a certified financial technician by the International Federation of Technical Analysis, as well as a chartered market technician of level 2. My main focus is not only to provide you with trading signals or trading analysis, but also to provide you with the trading education to make sure that you can be a trader too, and you can be your own analyst by time. Uh, I'm not so happy with you being a follower of what I do on a daily manner. Yes, I do send analysis to our clients. I do give trading recommendations and so on. However, at the end of the day, my main focus is to make sure that you, by time, develop your own analysis skills and education as well as knowledge to make sure that you, by time, can be a trader and you can be your own analyst and you can develop your own trading skills by time. This is my main focus, and this is why we are here today. So let's get going at the moment. DU Prime is a world leading online broker firm. So basically, we are here to help you get access to the financial markets through our more than 200 financial products in the financial markets. You can get access to whatever that you would like to trade on, whether it's forex, currencies, indices, commodities, shares, or even cryptocurrencies. Anything that you would like to trade on the spot is basically or could be reached through one platform, which is MetaTrader 4, through one broker, which is PU Prime. We basically mentioned during the past two sessions a quick brief about the markets that you could trade, which is the forex currencies, indices, commodities, shares, cryptocurrencies, etc., etc. And we mentioned even the platform that you can trade on, the MetaTrader platform, and we gave a quick brief and explanation about the platform and the user interface and how you could enter and exit positions on the platform. All of this you could basically reach through one broker, which is PU Prime. Very easy access and very easy with no any entry barriers whatsoever. This is done through our broker, PU Prime. Let's get going into today's content table. What will be discussed in this session is basically an introduction to technical analysis, because basically we mentioned financial markets during the past two sessions. We mentioned what instruments you can trade on and how you can trade on those instruments, on which platforms, etc. Um, However, we need to know if you have access to this platform and you are ready to trade on those instruments, how will you take the opportunity, or how will you take the decision to buy or go short? And we even explained how to go short, etc. The investment decision or the trading decision itself, you need to know or to understand exactly how the analysis will work. So we will need to understand today, what does the technical analysis mean, who is Charles Dow, and basically why we need to understand and to know who this person is, because basically He is regarded as the godfather of the technical analysis, and we basically use much of his works and his theories as of our daily tasks and what we do in our daily analysis. What are the basic tenets of Dow's theory? Uh, and then we will skip and jump into the charts on how to read the chart trends and try to ride the trends, because this is how we make money. If you know that the gold price will increase during the next 1 month, it would be a good buy opportunity. On the other side, if you know that the dollar index or the dollar currency will be going down for the next 1 week or so, it will be a good opportunity to go short on the dollar index, etc. So how to know the upcoming trend and how to read the trend, this is what we're gonna talk about. And the last thing and the last point we will mention is the trend reversal point, which is a key thing to mention. This is something that I personally use daily in my analysis that I do send to the clients. And by this, we wrap up our session. So let's start our session today with the point number 2. Who is Charles Dow? Basically, Charles Dow was never an analyst. He was basically a financial journalist. Back at the 1900s and 1800s, when he used to be a financial journalist, we didn't have any computers and internet connections and so on, etc. So he used to be a financial journalist. He woke up every day, he went to the stock markets, he wrote down the stock prices, he went back to the journal that he worked for, and he published those stock prices to the public. Each and every day he have done this job for ages, hundreds and hundreds or tens of years he has done this. More than 25 years of doing this, writing down and publishing daily the stock prices. Through years basically of experience, he started somehow to develop a sense of how the financial markets work. Okay, he started to know that some prices on some specific stocks basically repeat themselves in some sort of manner, in some sort of behavior. And when this happens, that specific behavior occurs in that manner. So he started to formulate what means, or what turned out to be something called the Dow Theory. He never meant to name it Dow Theory. Basically, this happened after he passed away at 1902. However, his diaries and his writings, editorials in Wall Street Journal basically was named after his death as the Dow Theory. Through years of experience of doing this in the Wall Street Journal, he started to get this sense of what he was writing in the journals, and he started to get some sense of how the markets work. After his death, one of his friends, whose name was Robert Trier, started to collect his thoughts and his editorials and what he published in the Wall Street Journal, and he formulated the Dow Theory, and he wrote down some basic tenets of the Dow Theory in what seems to be 6 points written down here. How the Dow Theory works. Those are basically the Dow Theory basic tenets that we use till today. For ages, we have been doing this for hundreds of years. Number 1, the market discounts everything. Number 2, there are 3 primary kinds of market trends. Number 3, primary trends have 3 phases. Number 4, indices must confirm each other. Number 5, volume must confirm the trend. And number 6, trends persist until a clear reversal occurs. We will explain this in more details in the not the following slide, but the one after. Okay. What is the technical analysis? So after the death of Charles Dow, who somehow encouraged the beginning of the technical analysis without aiming to do so. He just had some thoughts and some ideas of how the markets work. He wrote down some editorials and he passed away. Robert Rhea collected this and he formulated the Dow Theory. We started to collect this, we started to collect the Dow Theory, and we started the technical analysis. Technical analysis is basically not a science, it is somehow an art or a methodology for analyzing and forecasting the price direction based on the past market data. Charles Dow, basically, through years and years of experience, noted and he took notice that, for example, on a specific stock X, let's say we have a stock named X, okay? He took notice that if stock X went up to price $40 per share, the following day would see a decrease in the stock price back to $39 per share, for example. Maybe after weeks or even months, if this stock X came back again to the same price, $40 per share, he had expected that the following day would see another decrease in the stock price. So he expected that $40 per share is the maximum price that we can see on that specific stock. Most of the time, this actually happens. Later on, we will call this $40 per share as resistance. But this is basically the basic, let's say, mentality for the technical analysis, that there are some specific prices we will see again and again, support and resistance, trend lines, key Fibonacci levels, and so on and so forth. Those levels will basically mean that this important supply and demand will happen around those levels, which means that they will be market turning points. This means that some selling and buying will happen around those prices, and we will be able to expect what will happen around price $40 per share on stock X, etc., etc. Let me tell you that if stock X right now is on price $40 per share, will you go and buy this share right now? If I mention to you that it has retreated from this price 2 or 3 times previously, you'll say, of course not. Every time it basically reaches $40 per share, it comes back down to $35 or even $30 per share. It's not a good buy at the moment. So yes, exactly. It's not a good buy at $40 per share because as per the history that we have for this stock, every time the stock reaches $40 per share, it comes back down again for some specific reason that we are not basically interested to know, because in technical analysis we don't study the reason, we only study the effect. Other areas of analysis like the fundamental analysis and the financial analysis, quantitative analysis, etc., etc., we might be interested to know the reason. But in technical analysis, we are not at all interested to know the reason, we only want to know the effect. So the effect is that for $40 per share, stock X is not a good buy. It will go down with a high probability. So we will wait for it to go down maybe to $30 per share. If I tell you that as per history, every time stock X goes down to $30 per share, it goes up again to $40. Then it becomes a good buy. Of course, you will be able to buy at $30 per share to $40 per share, and you'll be able to make, well, about 25% in profits just in one opportunity, because it's only based on history. History tells you that price X basically goes up and down from $40 to $30 as per this fluctuation based on its history. So technical analysis, just to cut it short, is a methodology for analyzing and forecasting price direction based on the past market data, primarily price as well as volume. Charles Dow compiled and analyzed American stock market data, publishing some of his findings in Wall Street Journal. He believed that patterns and business cycles could be found in this data, a concept that became known as Dow Theory. Dow, on the other hand, never advocated using his ideas as a stock trading strategy. Let me check the comments real quick. I can see some private comments coming in. Okay. So that's all for the technical analysis introduction. Basically, we will be answering the questions at the end of the session, okay? So we'll be having a question and answer session by the end of the webinar. So we will keep it for now. Okay. So what are the basic tenets of Dow theory? As we mentioned, there are 6 tenets of Dow theory. He never wrote the basic tenets of Dow theory himself. Okay. However, he passed away. All he left was basically some thoughts and editorials left in Wall Street Journal. However, after he passed away at 1902, one of his friends, Robert Rea and Robert Hamilton, basically concluded those editorials and thoughts and somehow gave a brief summary of what he wrote, and they gave us this Dow theory thing that he never basically named after himself. They did for him. So the basic tenets of Dow theory are basically 6. Okay. Number 1 mentions that the market discounts everything. And the market here, the word market equals to price. So if we substitute the word market with the word price, it should be the price discounts everything. And this which should give us the same meaning, which means that the price for anything should, according to Dow theory, discount everything. This basically means that, for example, if we're talking about a price of stock X, the price is now at $40. As per Dow's theory, this stock currently at $40 should discount, which means it should reflect, it should include all of the public and even private information. It should reflect all of the positive as well as negative information that should influence the stock's price, whether positively or negatively. And by the end, the stock's price is at the moment $40. So Dow's theory means or hints that basically the price is basically fair. This is the fair value of the price. Okay. So the price discounts everything. So at the moment, if you're talking about the gold price at the moment, let me check how much is it. At the moment we're talking about our gold price is $1,705. Okay. This should reflect all of the private and public information that should either positively or negatively affect gold price worldwide. This should include anything that economically should affect inflation numbers worldwide, that should affect the geopolitical tensions between Russia and Ukraine, should affect geopolitical tensions between US and Iran regarding the nuclear negotiations. Anything in the world, whether public or even private, should be reflected in the price for gold, because basically gold is a worldwide commodity that's affected by geopolitical tensions, by inflation, by everything roughly. So according to Dow's theory, the price for anything should discount and should reflect everything that's affecting its price. Okay. Number two is that there are three primary kinds of market trends. If we're talking about cryptocurrencies, for example, and if I may ask you, um, what is the trend for the cryptocurrencies? I can get two answers. Okay. One of you can say the trend for cryptocurrencies is basically going up, and someone else could say the trend for cryptocurrencies is going down. Basically, both of you are 100% correct. Why is that and how? They are both two opposite answers. The first one who mentioned that the trend for the cryptocurrencies is going up, he basically is talking about a longer time frame. He maybe could have understood that I mean the cryptocurrencies since 2008, since the beginning of cryptocurrencies, since the Bitcoin was basically for a couple of cents. So, yes, since 2008, Bitcoin used to be for a couple of cents, and now it's around 19,000. So, of course, the Bitcoin price is going up from a couple of cents to $19,000. Of course, the trend is going up. Not only Bitcoin, you can see this on Dogecoin, you can see this on Luna, etc., etc. Most of the cryptocurrencies are basically going up since the evolution of the cryptocurrencies. Okay, so he's 100% correct that since the beginning of the crypto, the uptrend is basically the dominant trend. However, the other person who mentioned that the trend for the crypto is down, he never mentioned since the beginning of the cryptocurrencies. However, he meant that during the last 2 or 3 months, the crypto is going down, prices are going down. And yes, we can see that during the past 2 or 3 months, or even 6 months, the crypto markets are having a bloodbath. It's going down heavily due a lot of factors. Of course, the Federal Reserve is raising interest rates. Money is going into other investment opportunities, etc., etc. We can talk about the reasons in another webinars. However, the result is the cryptocurrencies as a market is going down for a couple of months. So he was basically correct. When I asked about the trend for the crypto, he mentioned that it's going down because it's going down for quite some time. So basically, they were both correct. However, I was the one uh, who asked the question in a wrong manner because I didn't mention the time frame. Because we have three primary kinds of market trends as per the Dow theory. We have trends according to the time frame. If we start by asking what are the time frames or the market trends according to the time frames, let's start with the primary one. A primary trend is the main trend. It's the longest type of trend according to the time frame. It's basically more than 1 year. So basically, the first person who mentioned that the trend for the cryptocurrencies is up, he was talking about the primary trend for the crypto, and he was correct. The primary trend for the cryptocurrencies is going up, and yes, I can say he was correct. However, the second person who mentioned that the trend was going down for the crypto, he was talking about the secondary trend. The secondary trend is somehow shorter in time. It takes from weeks to months, with a maximum of 12 months in time, because any longer than 12 months should be a longer than 1 year, and it's now more than 1 year, and it will be a primary trend. So it's now a secondary trend because it's only less than 12 months. Okay, so a primary trend, it's more than 1 year. How about less than 1 year, less than 12 months? Any less than 12 months, but more than a couple of weeks, is basically a secondary trend. How about less than a couple of weeks? If we're talking about a matter of days up to 2 weeks, this is basically a minor trend. And this is the short term fluctuations that we will be having in the daily trading and so on. Okay, so the trends will change. You won't have the cryptocurrencies booming for no end. It will boom for some time before retreating back for some correction, before going up again, before retreating. And while in this bear market, or in this period when markets are going down and crashing, you might have a couple of days when things are going up a little bit before going down again, and so on. So markets are basically going in both directions, up and down, up and down, up and down, for a couple of days up and then a couple of days down, and etc. etc. So they are divided into three primary kinds of market trends depending on the time frame. The primary is more than 12 months. Secondary is from a couple of weeks till a maximum of 12 months. And the minor trend is basically from a couple of weeks till the minor from a couple of days till basically a maximum of 2 weeks. Okay. Number three in the basic tenets of Dow theory is that basically the primary trends, which is the one that lasts for more than 1 year, this basically have three phases. In a bull market is basically a market which is going up. Okay. A bull market, or a primary bull market, which is a market which is going up for more than 1 year, has three phases. This is mentioned as accumulation, public participation, and excess phase. I don't want to get into much details at the moment because this isn't a full course about technical analysis. We are just giving a brief hint. However, let me go through this quickly. Accumulation is basically when smart money, when big banks, when big investors are basically slowly buying into things they believe will have a bright future into the going forward. I mean, back in 2008, 2009, and 2010, etc., when smart money had this investment opportunity, and they saw that the crypto might be the future, they basically bought back at Bitcoin when it used to be for $500 and $600. They basically accumulated some huge amounts of Bitcoin and cryptocurrencies back in the beginning of the upward trend, which is the primary bull trend. So that was the beginning of the accumulation phase. Then what happened? Then we went on to the public participation phase. Everyone knew about Bitcoin, and yes, now everyone could go into the public participation and everyone could buy Bitcoin. Then what happened? We went into the excess phase. You could see news about Bitcoin everywhere. Everyone is talking about how well Bitcoin could be a second source of income, and how well it could make profits for 100 or 200 or 500% per day, etc. Then you only know it's the last phase of the primary bull market. That was when the Bitcoin was basically around $60,000 and $70,000. Now it's only $19,000. So it basically, the bull trend ended already in the Bitcoin, and we entered in the bear market. Okay. What are the three phases of the bear market? We have the distribution. The distribution is the opposite of accumulation. When the smart money who first bought at $500 and $600, they start to feel that everyone is basically getting into Bitcoin. They feel that they already made very good profits. They have done millions and even trillions of dollars in profits, and it's time to sell. It's time to distribute what they have and to take their profits. After distributing, Bitcoin starts, or the cryptocurrency starts to go down a little bit. So everyone starts to sell. Everyone starts to somehow tried to jump out of the, let's say, boat before it sinks. And the last thing is basically the panic before everything crashes down, and so on and so forth. Those are the three cycles and three phases of any primary trend. A primary trend is a trend that takes more than a year. The three phases basically couldn't um, take place in any secondary or minor trend because it doesn't take more than a year. However, any trend that takes place in more than a year should take place in those three phases. Okay. Number four is that indices must confirm each other. If we're talking about the US stock market, and we mentioned indices previously in the previous sessions, if we're talking about the US stock market, the Dow Jones, for example, if the Dow Jones is going up, that's one index of the US stock market. We must confirm that the US stock market is in an uptrend by checking the S&P, by checking the Nasdaq. All of the US indices must be bullish in order to confirm that the US stock market is basically healthy and is promising in the future. And the opposite side, if the Dow Jones is going down, we need to confirm that the stock market is overall bearish or going down by confirming that the Dow Jones, Nasdaq, S&P, and all of the indices are basically looking bearish and they are looking bad to the downside. They are looking not so promising, to confirm that the US stock market as a whole basically is not so promising in the future. Volume must confirm the trend. This is something that we will not be mentioning in the moment because we need to confirm and we need to explain what volume is. And this should be done in a full course for technical analysis. We could basically mention this in another webinar. Trends persist until a clear reversal occurs. Basically, a trend has three types: an uptrend, a downtrend, or a sideways trend. Prices can either go up, go down, or go sideways, or go up, go down, go sideways, up, down, sideways, and so on and so forth. By using Newton's second law of force or second law of motion, that a body in motion, I cannot remember the law itself. However, a body in motion will stay in motion until an external factor stops it or something like this. The same applies for the trend. A trend will continue moving in the same direction until a clear reversal occurs. I mean, the trend is an uptrend until something occurs here for a reversal to take place and prices start to go down. Here, something will change the trend for prices to go sideways. Here, something will happen to encourage prices to go up. Then here something encourages prices to go sideways, and so on and so forth. So yes, trends happen for a reason. They are expected to continue in the same manner and the same direction. However, they are not meant to continue forever. They are meant to continue for some time for you to make profits from that trend, for you to get out as quickly as possible before the trend ends and before your profits gets wiped out. Okay, that's basically it. Let's have a look on the charts, how to read the chart trends and write them. I believe you can see my platform at the moment, which is tradingview.com. This is my main analysis platform I use basically for my daily analysis. Okay, great. So here we have the dollar index, okay, and basically this is a daily time frame. What is a trend? Basically, as we mentioned, we have three types of trends, whether an uptrend, a downtrend, or a sideways trend. In this case, let's have a look on an uptrend. If you have a look on this dollar index real quick, and if I tell you what type of trend this is, your answer should be quick, which is an uptrend. Why is that? because basically here's the chart. Okay, on the y-axis here you have the price. Let me just remove this for this to be more clear. Yeah, here we go. On the y-axis here you have the price, and on the x-axis down here you have the date and the time. You can see clearly that as time goes by, price is going up, so it is an uptrend. Okay, this is a clear example. It's very easy to see that the dollar is going up by time. Okay, and this is one of the very clear examples of an uptrend. You can see it by your naked eye. However, we have another way to know whether this is an uptrend or a downtrend. Simply by drawing the peaks and the troughs, or highs and lows. What I mean is, let's start here. This is a high, this is a low, or this is a peak and this is a trough. This is another high or a peak, this is another low or a trough. This is another high, another low, another high, another low, high, low, high, low, high, low, and here's a high. Okay, so basically price will move in a series of highs and lows, or a series of peaks and troughs. If you're talking about an uptrend, so the series of highs and lows, or peaks and troughs, should be higher highs and higher lows. So an uptrend should be a series of higher highs and higher lows. That's basically it. So yes, without having to basically draw the highs and lows, it was quite visible for us to see that it's an uptrend. However, in other examples, it won't be as quite as visible, or quite as easy to see that this is an uptrend or a downtrend. Sometimes basically markets will go up and down, sideways, up and down, and sideways. You won't be able to get it real quick with your naked eye. Sometimes it will deceive you into thinking it's a sideways while it's basically an uptrend, and so on. So basically, if you want to be a good analyst, you must be thinking like a good analyst. You must be analyzing the markets by the book. Where are the highs and the lows? Here are the highs and the lows. Are the highs higher than the previous highs? I mean, if this high, is it higher than the previous one? Yes, it is. Is this high higher than the previous one? Yes, it is. Is this high higher than the previous? Not so higher. Maybe we can say it's um, equal highs. That's not a problem. However, is this high higher than previous? Yes, 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 and so on. What about the lows? Higher lows. Each low is higher than the previous low, and so on. And this is how you know this is basically um, an uptrend. Okay. We need an example around the, or about the downtrend. Talking about the downtrends, let's have a look on the gold price. I think 8 hours should be fine. That's a brilliant downtrend. How do you know it's a downtrend? You have one of two ways. The easy way, you simply have a look with your naked eye. Yeah, the price started here around $2,050 per ounce on gold trading. It's now $1,712 per ounce. Of course, price went down. It's around a decrease of $340. Of course, it's a downtrend. However, if you don't want to depend on your naked eye, if the example is much more harder than this, what do? You simply draw the highs and lows. So this is a high, this is a lower high than the previous one, a lower low than the previous one, another lower high, another lower low. That's quite simple. Really, really easy. Higher highs and two higher lows. So here, because basically it's the opposite direction, we're talking about a downtrend. So it's a series of lower lows and lower highs. Not sure if I got this right. I believe I was saying it wrong. However, a downtrend is a series of lower lows and lower highs. We have here a lower high and a lower low. Let me explain this. That's a high. Okay. What is this? Is it a high? It is a high. However, it's a lower high. Another lower high. What is this? It's a low. What is this? Is it a low? Yes. However, it's a lower low. So this is a downtrend. It's a series of lower lows and lower highs. And this is how you know a downtrend. Okay? We need the last example of a sideways trend. Basically, I'm not sure what in the market at the moment is moving in a sideways range. However, we will try to get something moving in a sideways range. Here we go. What is this? Let me get it and let me zoom here. This is pretty much a perfect sideways range because basically, what is this? This is a high. This one here. Okay. What is this? It's another high. It's an equal high. We roughly have another high at the same distance, or maybe I mean at the same price of the previous one. Okay. Okay, what is this? It's a low. What is this? It's an equal low. So overall, if I asked you within this chart, this is basically the chart for the US dollar versus the Swiss franc, okay? If I ask you what is the dollar versus the Swiss franc doing, is it going up, going down, or it's doing nothing? You will tell me basically it's doing nothing. Of course, it's doing something. However, the outcome is it's somehow going up and then going down and then going up again and then going down again. The outcome is it's moving in a sideways range. It's fluctuating within a given amount. So it's not going up, it's not an uptrend, and it's not a downtrend. It's called a sideways range. So in this case, we say that a sideways range, a series, is basically a series of equally formed highs and lows. This is basically what we have here. So an uptrend, higher highs and higher lows, a downtrend, lower highs and lower lows, and the sideways range is basically a series of equally formed highs and lows, and those are the three types of the trends. Here we come to our end of our session today. If you have any questions, please leave it in the chat box real quick. Okay, the questions that have been sent to me privately will basically be I'll be responding to those privately. I'll be sending my email here in the chat box. Just a moment, please. It's mohammed.yaoud@puprime.com. Okay. Please forward your inquiries or questions to my personal email at puprime.com. Okay. For people who would like some personal advice or something regarding their trading accounts or anything, because there are some questions that have been sent to me privately here, I will not be able to respond to publicly. So please forward those questions to me because whenever I end this session, I will not be having access to the questions or to people who sent those questions. So please send it to me through email so I'll be able to answer those to you. Okay, great. Thank you so much for joining me today. We will be meeting up again during next Thursday for the last session during our campaign. You can be a trader too. I'm excited to wrap this campaign with you. If you have any questions, please send it to me on the personal email. Thank you so much for joining me today, and we'll meet up next Thursday. Please stay safe and please enjoy the rest of your evening. Goodbye.